This is Eric L. Donovan, the Mindset Disruption Strategist. Let's talk about investing. More specifically, let's talk about the numbers that Wall Street doesn't want you to see when it comes to thinking about investing. But before I do that, please subscribe to this channel and don't forget to hit the notification bell so that you can continually be updated as I release new videos, just helping you think about how to redefine success and build generational prosperity and impact. And when it comes to investing, there are lots of ways to do that, and the world is not giving you all the information that you need. So let's talk a little bit about the numbers that Wall Street doesn't want you to see. And before I get into this, let me just make kind of a quick comment here, which is the reason that they don't want you to see these numbers is because there are a lot of products and a lot of investment strategies that if you knew the truth and understood what's happening here, would actually eliminate your need for them. So if I'm sitting inside of the Wall Street industry, why would I want you to know these numbers? The other thing that I like to say about this is that there's an unconscious manipulation going on, meaning this is being fed from the top. It's not something that I think that people are doing necessarily on purpose. I think it's more just kind of a matrix moment of take the pill and open your eyes to what's really happening. Because when I saw this, I was like, wow, something different needs to be done. So let's take a look and just talk about what I like to call the scary truth. So this first number is going to come up and I'm like, inflation 2.2%. And depending on when you're watching this video, you're like, Eric, you're crazy. When was inflation just 2.2%? I mean, we're sitting in an environment as I filmed this video of 8, 9, 10% plus type of inflation. Well, about a year ago, the average inflation looking back over the last 30 to 40 years was around 2.2%. So that's where that number is coming from. I definitely understand we sit in an environment. It's actually going to make my point even more when we get done. So bear with me. Inflation typically runs about 2.2% on average over a long period of time, knowing that that's not the environment that we sit in today. The other thing that I would tell you is if you own an investment account that's in a taxable account, more than likely, based on calculations that we've run, you're giving up about 1.02% just to paying the taxes on an annual basis for just short-term and long-term capital gains taxes and things that are coming out. And I know if you have a tax-deferred account, maybe you eliminate this, but I think it's worth at least looking at the whole picture of what is happening. And then finally, on average, the fees that get paid inside of an investment account are around 1.65%. And I know what you're going to say, especially if you have an advisor. You're like, Eric, no, I have some ETFs and some other things like that. My advisor doesn't charge that much. Well, maybe. But here's what I'm going to tell you. Even if you're like, well, my advisor doesn't charge that much, what you're going to find is if you start to peel back the curtain and look at the underlying assets that you own, this is the average fee most people are paying, 1.65%. And then other hidden costs that are inside of the funds that they don't necessarily have to disclose, trading costs and management costs and other things like that that are happening. Again, 2.2% inflation, 1.02% taxes, 1.65% happening on fees. And this is the mountain that the average investor has to climb in a normal market environment. But it gets worse than that, because the question is, well, how does the average investor perform? How does the average investor do? And this is scary. Your average investor returns about 2.9%. This is something Wall Street also does not want you to see. Why is that? Because the reason that this usually happens is because of all the fear and greed that they peddle on a daily basis. Here's all the reasons you need to get out of the market. Here's all the reasons you missed out. And here's the hot sector you missed out on. It's either fear or greed. They're constantly selling you, which what we find that leads to is emotional reactions by your average investor. So 2.9% is their average return. This is a study done by Dalbar, who looked at how does the average investor return. I mean, that's just terrible. Because we're going to look at in a minute, I mean, that's barely ahead of inflation, but it all is emotional reaction rather than what the actual market environment is doing. But what we don't realize is take all these numbers and realize that the average investor is doing 2.9%, inflation at only 2.2, taxes at 1.02, fees at 1.65. Your average investor is losing money. It's why they're so frustrated. And you may be sitting in this boat. It's like, I felt this. I saw this on my account statement. Ugh. But no one would tell me this. It's right. Wall Street doesn't want you to see this. They don't want you to recognize that this is actually what's happening. Because at the end of the day, what you need to understand is if you're not doing things to mitigate inflation, if you're not mitigating taxes and you're not mitigating fees, you are facing an uphill battle of 4.87% that you've got to overcome just for escape velocity on your investment portfolio. What kind of advertising program would run on any of the news channels or any of the newspapers or any of the apps or anywhere else that you might go if this knowledge was readily known? Why would Wall Street want you to know this? The other thing is when it comes down to products, you talk about minimizing volatility. Another word for minimizing volatility is, minimize your long-term returns. They'll never tell you that, but you don't want to lose money. You don't want to invest in something that might go down over the short term because they're not talking about volatility on the short term equals volatility on the long term, which is also the upside. So when they're talking to you about products, they spin all this language at you that sounds frou-frou and really good on the short term, but is costing you more than you ever realized. And let me show you what I mean. So if I look at the long-term performance of stocks over the last 70 to 80 years, what I come up with is an average annual rate between small and large caps. This is a mixture of stocks. So it's small and large companies. The average return is around 11% per year. But remember, if we're not mitigating these other things, it's not really the return that I'm getting. So we're going to talk more about that in a minute. 11% for stocks. Well, so the way that you minimize volatility is you buy more bonds, Eric. That's what you do. It's a diversified portfolio. The old typical 60-40 portfolio is what everyone should be doing. Well, do you realize bonds long-term return is really only about 6%? And then, well, what about annuities? Annuities are great. Annuities are insurance products that have investment wrappers sitting inside of them, and 4%. The average return that we find that most annuities pay out. And then it's like, Eric, the ultimate protection against my investment is gold. Whenever the market looks like it's going to do bad, when the economy looks bad, what I want to buy is gold. Guess what? Over the same time period, we're looking at a 4% return. And the entire marketing media is not telling you this truth or explaining to you what's happening, because as much as stocks, high quality, really good companies that are doing good long term, they have the best performance for you. Because look at this, even if, and there are ways, let's understand, there are ways to mitigate the taxes and the fees. The inflation, we've got to talk about, there's things that we need to just manage through and own things that do well in an inflationary environment. But let's just say that you could not control that 4.87% drag. Then what are we looking at? Well, stocks really give you about a 6% annualized return after it's all said and done. Bonds, only about 1.13%. An annuity, flat. And if you own gold, but you're facing these same issues, you're actually losing money. But what kind of advertising could I sell if I just said, hey, what you need to do is go buy really good, high quality companies, set them and ignore them? I talk about this in another video, which is the fact that any money you're going to need in the next 5 years, never, ever, ever put into stocks. The volatility of the stock market and the uncertainty of it is just unknown. Over a 5-year period, I feel pretty good about it. The further that goes out, the closer we get to this 11%. Any 5-year period could be really kind of random. I don't know for sure where that's going to be. But if I've got 5 years or longer, that's where I'm putting my best bet, because what I know, see what they're going to tell you on TV or on the web or in your app or in even the forums that you go to, typically the language you're going to get is your greatest risk is volatility. It's the up and down. That's not your greatest risk. Your greatest risk is inflation, taxes, and fees. Because until you understand, especially on the inflation front, let's say that you could eliminate the taxes and fees portion of this. Inflation's still your number one, chasing you down from behind. And what asset in here beats inflation? hands down, stocks over and over again. Now, do you have to put up with temporary volatility? You do. And when I talk about stocks, I would encourage you to make sure, look at some of the other videos on how to really look and select high quality companies that you'd want to put into a portfolio, because there is a strategic system that I would use to make that decision, because owning the right types of companies will make all the difference long term. But Wall Street doesn't want you to know this, because they can't peddle their products. They can't sell you on fear. They can't sell you on greed when it gets this simple. And you're like, Eric, this is too simple. It's not too simple. What you need to own is a good portfolio of high quality companies that you know will do well long term, and then ignore the short-term volatility, because short-term volatility has nothing to do with long-term value, because what somebody's willing to pay for something today doesn't tell you what the long-term utility value of that company continuing to do business and operating well, and what that means longer term. So take this information, use it, become a person who is informed. And when it's time to make your own investing decisions, you can do that in a way that will make an impact and build generational prosperity, because you have information that Wall Street doesn't want you to know. God bless you. Have a great day.